All right. Hello. Good afternoon, everybody. This is George Papazov from Trade Pro Academy. Hope you're having a great day. Welcome to our midday market update for December 15th of 2016. We got some stuff to talk about today. Most importantly, the FOMC decision to hike rates yesterday by a quarter point. Didn't catch anyone off guard. It didn't surprise them. But the other thing that the surprise was that actually did catch the market slightly off guard is a bit more of a hawkish stance. And a hawkish stance referring to an expectation for future rates to increase on a faster trajectory. Janet Yellen made some interesting comments in her press conference as well, all right, when she was asked about not monetary policy, but fiscal policy, which is more spending, government-related, how they use the budget. And in that sense, she responded, well, I don't think new fiscal policy is needed. I think the economy is doing well. We don't need any more money thrown at it. That's kind of where her stance. And then she quickly corrected herself and said, oh, but I mean, what I'm trying to say is I'm not telling the new administration or Trump how to do their job. I don't want to be misconstrued that way. But you could see she's a different plan, different mindset, different theory than maybe where Trump is headed. She will finish her 4-year term. The Federal Reserve and the president's terms are not matching on purpose. That's to separate the conflict of interest from an administration to the monetary policy organization as the Fed. So she had some of that in there. She also said the economy's picking up a little bit, doing a little bit better. Said inflation, they're still on their way, and the labor market's looking strong. So all in all, what do we get? We got a hike, ladies and gentlemen. We also don't have the most recent. Oh, no, where'd it go? Darn it, I had the entire, I had the curve here. I got to show you something, okay? They basically raised rates by a quarter point, and they also said the following. Here, let me Fed dot plot December 2016. I think Business Insider has a nice edition on it. Yeah, here we go. What really caught the market off guard is the Fed saying they're going to raise it 3 times next year. Goldman Sachs, Citi, all the banks in Europe, Japanese banks, a lot of institutions, analysts, they all said we're expecting 2 hikes in December 17th. In September, these pinkish dots versus the blue ones, the expectation was here. Look at it now. For 2017, it's higher. Not only are interest rate expectations now higher, but the other thing that's higher is the number of times they're willing to hike, and that's 3 times. So that caught the market off guard. That was hawkish. The market got scared. Initially, it popped because they were relieved that we got the 0.25. All right, we kind of met what was expected, but then just absolutely tanked throughout the day. And the reason it tanked is the expectation of 3 rate hikes. I think this morning the market woke up and said, wait a minute, last December, what did Janet say? Said 4 hikes in 2016. How many did we get? 1. All right, so now what she's saying is 3 in 2017. How many are we going to get? Maybe 2. So they always overshoot hawkishness or say they're going to raise rates faster than they actually do. But you need to know, 2017, the expectation in blue is higher than it was before. 2016, the year is pretty much a wrap. 2019, you could see a lot of Fed members have voted higher and higher than the previous meeting in September. And longer term, they've agreed it should be about 2.75 to 3% for the longer run. What does that mean? Does that now mean that when you go to your bank and you deposit cash, they're going to pay you interest rates? Hell no. Good luck waiting for that. Go ask your banker, hey, I'd like to have some more interest on my term deposit. Yeah. See what they say. What's happening is borrowing costs, however, are going to increase to the consumer. And expectation is they're going to continue to increase through 2017. She said, Janet Yellen said she doesn't want to run the economy hot. All right. She is not a fan of that. So with their stance, and here's the actual statement from the Fed. I'm going to show you the statement and how the language changed. It was taken as a very hawkish stance, and that's why the market rallied a little bit. They basically said that economic activity, they scratched out, picked up has been expanding at a moderate pace, all right? And they said instead of has been solid on average, in recent months, an unemployment rate has declined. So there's giving a lot of terminology in the statement to show some positivity in the economy and backing up the reason they think 3 hikes are necessary in 2017. All right. They changed against the backdrop to in view of realized and expected labor market conditions and inflation. So they're saying not against the backdrop of, but now they're acknowledging that it's realized what they're looking for. All right, so they've raised a 1/4 point to 1/2, and they kept pretty much the rest of the statement the same. There were no dissenters, and a few of the FOMC voters are actually moving on in 2017. They're rotating out of their positions as voters, and they were mostly hawkish dissenters. Okay, if you know that much already, then great. If you haven't learned anything new, then phenomenal. You're 10 steps ahead of the curve on how most traders disseminate and analyze information. Now, let's look at it from a market perspective. Initially, the market panicked. Who was surprised? Nobody, all right? Everyone got long to the neck on the previous day before that, expecting the market to continue higher. We had to shake out some of those late longs and the weak longs. Today's price action has absolutely annihilated shorts, squeezed them out, and I think we got some more upside. Okay, you could expect some choppiness here after such a big move, but everybody was long and on board. And then yesterday, with a little bit of that fear, anyone that wanted to take risk off, they used the rally as an opportunity to offload some of the SPOs or to hedge their portfolio. Remember what happens. The selling is very intense because it's twofold. One is longs puking, saying I'm done, or locking profit if they bought it, fortunately, from below. And second is hedging on the downside. If you're a fund that's got $10 billion worth of stock, are you going to sell individual stocks? Heck no. You're going to hold your long portfolio and you're going to short some SP500s to get some downside hedging to offset your losses on your long core portfolio. That's why when the market drops, it drops 3 times as fast. Once, because there's profit taking and short selling. 2, because there's hedging. And 3, because emotions to the downside are much quicker and much more fierce than they are to the upside. All right, that's why we had a nice slip here, right to support. Today, we've recovered half of that. I don't know where we're going to close. I can tell you this much. Support right now for the rest of the week will be at 2256 on the index. And above here where these candles are, 72. Okay. Right now, as a swing trader, I have no clue what I would do. If I was swing trading, I don't even know what the position I'd take. My swing portfolio is always long, and I hedge actively with put positions. And I'm going to show that to my subscribers after the YouTube broadcast ends. I'll show you what I had to do yesterday through this kind of chop. And it's interesting. It'll open your mind up a little bit because despite the downside, we didn't get really hurt as bad as you would think because of our hedging. And I'll show you how you roll that hedge to open it up and then how you close it back up when you're ready to rally and what triggers this hedge. So we'll talk about that from a swing trading perspective. From a day trading perspective, this is a day trader's dream. I'm loving this market. I'm pretty much every single click that I do, I make money. And I'm clicking often, so it's working. It's great. I love this kind of market. When you get some downside, you get volatility. I'm not a bear, but the downside trade always unfolds quicker and pays you quicker. All right. Moving on from S&P 500, it's no surprise that the dollar index has exploded. A stronger outlook for interest rates means a stronger currency on the dollar. So every pair against the dollar is getting crushed. Let's look at the Canadian dollar. There you go, from 132 to 134. So the Canadians hopefully bought some dollars down low. All right, let's see Japanese yen. It's absolutely exploded up to 118 on the pair. We talked about if we take this top out here at 114.5 to 115, there's a lot of buy stops. There they go. All right, let's look at the Euro USD. Getting absolutely crushed. 103.85. I could go on a weekly chart and you won't remember the last time you've seen that price. You may not even, wow, you hopefully were alive in 2003, but 2003 is the last time we crossed through there. All right, so we're hitting some really, really painful thresholds where institutions are having to dump, right? If it's over here, you can hold, you can hold, you can hold. If it's starting to break some of these like a decade almost low, the institution level has to dump as well, and that's what you're seeing. That's why volume's high. There's your Euro USD. That's a key pair. The dollar index just through the roof. I don't think I've seen it this high. Actually, pretty much since when? Since 02 and 01. I was going to say since I almost started trading, close. Started trading in 01. So, and it was a 116 at that level. So through these 104s, we probably got some more buy stops. I would say 106, 107 will be the absolute on this move before we consolidate. But that's the dollar. The dollar's driving. This weakness is driving, the strength, on the dollar is driving weakness on a lot of the other currency pairs. Looking at a currency chart. Let me show you something here. So this is a currency comparison. All right, as you guessed it, that blue line is the dollar. Has absolutely exploded to the upside, taking some pairs or most pairs down with it. So right now, when you're looking at currency trading, it is not a story of weakness across other commodity currencies or weakness across anything else. It's strength in the dollar. That's all it is. That's all you have to say. And oil, not surprisingly low because of that. I'm a buyer of oil at this level. I was looking for this gap to close. The gap is now closed. 50.10 should be a great support. It's acted as great support once, great support twice. I wouldn't be surprised to see oil back at 54, 55 and above even. All right, too many people got long too quick above 54. It cleaned out the short stops, so there's no more short sellers. They've now entered back into the market on the way down. All right, buyers that got late got stopped out, and when shorts enter and buyers get stopped out, we're ready for a rip again. So I'm looking at oil long at about 50.20 and above. That's my level. I'll be buying some oil and holding. I'll be building a position into it. Bonds are getting clobbered. Don't touch them. Gold, heck, if you have anything in gold, I feel sorry for you. But you should have known that was going to happen. Interest rate hike is terrible for the metal. All right, if you were just buying it, hoping for something before the earnings announcement, then when you're trading on hope, you should work for Obama's administration. You got elected on hope. Hope has no place in the market. I'll tell you that much right now. When your trade turns from logic to hope, it's going to turn from a winner to a loser. It's going to kill your psychology. Anywho, we said this. We dumped gold. I tried it long at 12. What was it? I think I tried her at 1,200 or 1,210. Dumped it right there, and I said, you know what? The hell with this. I'm going to move out of the way, let it fall. It'll tell me when it's going to stop. Right now, I think 22 might be kind of a support. Below there, forget the bullish side on these retracements. We got to start looking bearish. And I think even 1075 is on deck here. One level I've been following with on gold quite a bit. Here, I got to go on this chart. No, I don't. I got to go on this chart. I make it bigger for you. GC1 on a daily. Somebody's going to draw trend lines. I know how these swing traders work. I'm one of them. And start to ask questions if we're going to get down to 1,000. And who knows? You know what? We might. Right now, 1050 is the first level you got to watch on a longer-term perspective. And from there, below 1050, you're going to get a Euro USD type of slide through the bottom very quickly. There's a ton of stops there, but we got some ways to go. So on a shorter time frame, should you buy gold right now? Go for it if you want. I'm staying the hell away from this. Try to buy it here at work. Try to buy it here. Got stopped out. I'm staying away. I need to see something like this happen. A lot of traders tried to buy it just because the price is lower. Just because the price is lower does not mean anything. All right. Would you buy a toy for your child that says, hey, it's 40%? Let's say you want to buy one of those Tonka trucks. They're like $700, let's say, and they're really nice, shiny chrome on it. And somebody says, hey, it's only $60 for this Tonka truck. Would you just go pay $60 just because it's 60? No, you'd ask some questions. Why is it so low? Oh, it's full of lead. The entire plastic is just lead melted down and coated all over the Tonka truck. You're paying $60 for it? If it's cheap, there's a reason it's cheap. Stay away from this kind of price action. You're going to get clobbered. When you're catching a knife, look, I made a career out of catching a knife. But when you're catching a knife, this is how you do it. Take it from a guy who catches knives often. All right? You're catching a knife. You don't sit here and say, hey, come on down. I'm going to catch you. That's how you get your throat slit. You let it bounce once. When it's coming down, all right, maybe bounce a second time. When it loses momentum, catch that falling knife. Go for it. You got a shot for a spring higher. Just don't try it here. Because what if you try it here and here and here? And I know people, when I used to work on a trading floor and clients would call us to sell positions, would buy Enron. I asked them why, out of curiosity. Why do you want to buy it? Oh, it's cheaper. All right. There's a few Canadian tech companies too. Oh, they're cheaper today. Got to buy them. Well, guess what? The companies that are bankrupt, where can you find a chart of them? Where? Nowhere. They don't exist. There's a bias. Any company that currently exists obviously makes sense to buy the dip because it's around. Think about all the companies that have failed where you bought the dip to bankruptcy. It just takes one of those to wipe out your account. And there's a lot of those companies. There's more companies out there that have died that you can't see on a chart than you currently can that exist. Give that some time to think when you're buying dips. Not saying gold's going to be one of those companies, but that's on buying dips. And I need you to know that. All right, that's the market. How should you trade for today? I don't know. You should have your own strategy. Here's how I'm trading. I'm trading long S&P 500. I'll show the subscribers my trades in just 1 minute here. I'm going to start trading long oil below 50.10. I'm going to puke. Right now it's 72, too high to buy. And I'll wait for another dip. I think we'll get it at 50.10. Puke point below that. Try to get long. Build some bullish bias. US dollar, wouldn't be shorting it yet, but wouldn't be buying it. Too strong to buy and not weak enough to sell. That's kind of the sentiment on there. Gold, staying away from it. Bonds continue to get clobbered. Wouldn't be buying them. So honestly, long S&P, long oil, and just be careful. Don't get clobbered. Volatility is starting to pick up a little bit. Interesting things are happening with VIX. In the last few days, the VIX has actually risen with the market. Typically does not do that, but nothing's typical. I had a lot of traders say, what's going on with the VIX? Why is it doing that? I don't know. Trade it, man. Understand that if you know it's doing something, you know what it's doing. So just respect it and trade it. Don't understand it. By the time you understand it, it's over. The media can tell you what happened and why Trump got elected today, but on election night, the odds of it were what? 2% of Trump getting elected. Virtually no odds. Everyone was willing to make a bet. I made a bet with a guy for $100 and he gave me 50-1 odds. You think I'm going to forgive him for that stupid bet? Nope. I'm collecting on my 5Gs. I've had to place a few calls already. Next stop's the collections agency. Put a lien on the property. Why not? It seems so good. 51 odds for $100. You're that desperate for $100? I'll make you pay for it. It's a mistake you made. Doesn't mean I got to forgive your mistakes. I'll tell you one thing in my life, and I'll end it here. In my life, my mistakes were very rarely forgiven. And when I made mistakes, I owned up to them. I've worked hard for every penny I got. So if I can make another one, I'll take it. Any questions before we move forward? I'm going to show you guys the trades. I think we got a blockbuster opportunity here in the afternoon on S&P 500. YouTube, have a wonderful session. I wish you all the best. Be careful out there. Manage risk. That's what the professional traders do. You want to make money? Manage risk. Find good spots to get in. If you're getting in and getting stopped out quick, you're not getting in at the right spots. You just got to be a little bit more careful and tune your strategy up, and it can be done. Our futures course is ongoing. The next lesson is the 28th of December. Sign up for an Earn Package subscription, and you can participate in it live. We put together a training package that if you want to join Goldman Sachs, if you want to join any institution as a prop trader, that's the kind of education you're going to get. You're going to use the same tools as those traders. You're going to analyze order flow like them, and that's the benefit. You want to make money, that's the way to do it. If you could find another course online that does it to that extent, I'll give you $200. Email me. All right. To that extent, remember, to the extent that Trade Pro does it, which means you got to sign up for $79 to figure it out. All right, guys. Hope to see you on the subscription side. If not, we do these updates pretty regularly. Enjoy. Careful. FOMC has been hawkish, but the market's accepted it, and all dips are getting bought. I think we got new highs on tap, potentially as early as this afternoon. Take care and all the best. Subscribers, hang tight. I want to show you some stuff and a few trades.